In this video, we will be covering two price action strategies, the pin bar trading strategy and the engulfing bar trading strategy. By the end of this video, you will have a better understanding of these strategies and be able to use them to improve your trading. Let's start with the pin bar trading strategy. A pin bar is a candlestick pattern that signals a potential reversal or continuation of a trend. It has a long tail or wick, a small body, and a small upper or lower shadow. The psychology behind the formation of a pin bar is that price initially moved in one direction but then reversed sharply, indicating that the opposing side has taken control. When trading the pin bar strategy, we want to look for pin bars that occur during a trending market. In an uptrending market, our goal as price action traders is to find the best opportunities to join the buyers and profit from their market dominance. The most promising trade setups occur when the price pulls back to a support level after breaking through a resistance level. To understand why support levels are significant, it's important to understand how traders think. When the price reaches a resistance level, buyers will often take their profits, causing the market to drop and forming a resistance level. However, when this level is eventually broken and the market pulls back to it, it becomes a high-quality support level. Savvy traders will often look for buying opportunities at these levels, as buyers are likely to place new buying orders, anticipating a continuation of the uptrend and driving the market upwards to make profits. As a price action trader, your goal is to determine when a pullback has concluded and when the market will resume its upward trend. This is where the pin bar candlestick pattern comes into play, as it acts as a signal for traders to join the move. The pin bar pattern signifies a rejection of the previous price level and indicates a shift in market sentiment. By recognizing this pattern, you can confirm that the pullback is over and the market is likely to continue moving upwards. Let me give you an example. As you can see, the market is clearly trending upwards. After a pullback, the market approached a resistance level, which later became a support level. The formation of a pin bar signals the end of the pullback and the start of a new upward move. Therefore, it is likely that the market will continue to trend upwards from this point. Overall, this pattern suggests that traders may want to consider entering a long position. Once you've learned how to identify a pin bar signal during an uptrending market, you can enhance your trading decision by looking for additional factors of confluence. One such factor is the Fibonacci retracement tool, which can be used to measure the move and determine whether the pin bar formed at the 50% or 61.8% Fibonacci levels. In the chart, we can see that not only did we have a price action signal at the support level, but the pin bar also formed at the 50% Fibonacci level. This adds further confirmation to our trading decision and allows us to trade with greater confidence. In a downtrending market, we look for pin bars at pullback to support that becomes resistance. As a price action trader, it's important to understand that during a downtrending market, sellers are in control, which means that the best way to profit is by looking for trades that align with the downtrend. Let's take a look at an example. In this chart, the market is clearly trending down, with sellers leading the way. After breaking a support level, the market pulled back to retest it. However, it's uncertain whether the market will get rejected or break through the resistance level. But the formation of a bearish pin bar gives us a clear signal that buyers got rejected and sellers have taken control at this key resistance level, indicating the start of a new downward move. To add more confirmation to our trade decision, we can use the 50% and 61.8% Fibonacci retracement levels to see if the price action signal formed at either of those levels. In this case, we have a key resistance level, a pullback to it, and a high probability price action signal that got rejected from the 50% or 61.8% Fibonacci levels. This gives our trade a stronger chance of success. During a ranging market, we only trade the pin bars from support or resistance levels. We do not trade inside the range, as this can lead to false signals. Remember, when trading this price action strategy, we only take trades that offer at least a 2-to-1 reward to risk ratio. Next, let's move on to the engulfing bar trading strategy. An engulfing bar is a candlestick pattern where the body of one candle completely engulfs the body of the previous candle. This pattern indicates a potential reversal or continuation of a trend. When trading the engulfing bar trading strategy, we want to look for engulfing bars that occur during a trending market. In a strong uptrending market, we can use the engulfing bar as a signal to join the strong uptrend. Let me give you an example. Based on the size of the candles, it is evident that there is a clear uptrend in the market, and it appears to be a strong one. Therefore, you can use engulfing bars as a strategy to join this trend. In particular, the current engulfing bar presents an excellent opportunity to enter the uptrend. Another approach to trading engulfing bars is to wait for a pullback to a resistance level that becomes a support level. To increase the likelihood of success, you can use the 50% and 61.8% retracement levels as a factor of confluence. This means waiting for the price to retrace to one of these levels before entering a long position. Overall, these methods can be effective ways to trade using engulfing bars. In a strong downtrending market, we can use the engulfing bar as a signal to join the strong downtrend. The market is currently in a clear downtrend. If you wait for a pullback, you may miss out on potential profits. In this case, if an engulfing bar appears, it presents an excellent opportunity to enter the trend. However, if the downtrend is not as strong, you may choose to wait for a pullback to a support level that becomes a resistance level. To increase the probability of success, you can use the 50% and 61.8% retracement levels as a factor of confluence. This means waiting for the price to retrace to one of these levels before entering a short position. Overall, these approaches can be effective ways to trade in a downtrend. When the market is ranging, you should only look to trade engulfing bars from major support or resistance levels. It's essential to be cautious during this type of market since buyers and sellers are equal, and trading inside the range can be risky. Instead, you should focus on the most widely watched support and resistance levels during a ranging market. Once an engulfing bar appears at one of these levels, you can then consider entering a position. Thanks for watching. If you enjoyed this video, please give it a thumbs up and hit that subscribe button to stay up to date with our latest content. And don't forget to turn on notifications by clicking the bell icon so you never miss a video. We appreciate your support and look forward to seeing you in the next video.